Welcome to More Than Commas, where we explore how wealth is more than just numbers. It's about building a great life, and I'm your host today, Paul Adams, and today we're diving into the importance of disciplined investing. If you've ever found yourself comparing your portfolio to real estate, large cap growth stocks, cryptocurrency, gold, or whatever asset seems to be doing good at the time, this episode is for you. We'll explore why these comparisons can be harmful and how to cultivate confidence in your diversified investment strategy. Now, before we jump in, don't forget to subscribe, leave a review, and share the episode with anyone looking to strengthen their financial foundation. I want to start with a reminder. Comparison is the thief of all joy. We taught this phrase to our children because it's easy for children to get dissatisfied with a level of lifestyle the world has never seen before, all because they see something a little bit better. In the world of investing, this idea especially rings true. Now, let's say you have a diversified portfolio that's performing exactly as it's designed to. But then you hear about someone who made a killing in real estate last year. Or another year you hear headlines about some cryptocurrency that's gone up 300%. Suddenly, your portfolio doesn't feel so exciting anymore, and you start to wonder, did I make the right choice? Here's the problem. When you compare your portfolio to a single asset class or a particular stock, you are setting yourself up for dissatisfaction. You see, every asset class, whether it's real estate, tech stocks, or gold, will have some moments of outperforming a diversified portfolio. But those moments are both temporary and unpredictable. In addition, chasing these trends often leads to poor decisions. Many investors buy into a hot market when it's already peaking and sell out of a struggling market just before it rebounds. This buy high, sell low strategy is the opposite of what a successful diversified portfolio is going to do. A diversified portfolio is like a well-balanced diet. You don't eat only protein or only carbs, you need a mix of nutrients to stay healthy. Similarly, diversification spreads your investment across different asset classes, industries, and geographic regions. This approach helps you capture growth while minimizing risk. Sure, it might not give you the excitement of a skyrocketing asset class, but it offers something far more valuable: stability and consistent long-term performance. Now let's talk about why diversification works. Asset classes don't move in sync with each other. When one zigs, another zags. For example, when a tech stock is booming, bonds might be steady or unremarkable. When real estate hits a downturn, international stocks might pick up the slack. By holding a mixture of these assets and then systematically rebalancing, you're smoothing out the highs and lows, which helps you avoid the emotional roller coaster that leads to suboptimal decision making. With diversification, you should also be automating through rebalancing. The sale of the assets that performed well in the recent past by selling and rebalancing those assets to the ones that went down in the recent past. Rebalancing allows you to sell at relative high and buy at relative low.
This episode is brought to you by Sound Financial Group. At Sound Financial, we specialize in helping clients build strong, long-term financial strategies for their retirement. If you're looking for personalized advice to help manage your wealth, visit us at sfgway.com to learn more about how we can help you achieve your goals.
One of the biggest traps investors fall into is the belief that they could have timed the market perfectly. You might think, if I'd just bought into real estate 5 years ago or sold my tech stocks before the last crash, I'd be way better off. But let's be honest, nobody consistently gets timing right. Even professional investors with access to cutting-edge research and data rarely beat the market over the long term. The idea that you could have predicted the exact right moment to buy or sell is an illusion. Instead of focusing on what you missed, focus on what you're gaining. Your diversified portfolio is designed to grow steadily over time, regardless of market cycles. And as history shows, disciplined investors tend to outperform those who chase short-term gains. You just need to reframe success. Here are 2 mindset shifts that can help. Most people have heard the joke, investing is easy. All you have to do is buy low and sell high. but no one knows when the low or high is. And his history has shown us that most people do not sell in and out of the market well. Think about this: as you rebalance, you are by definition selling a portion of what went up, say in the last 3 months, to buy what did not do as well in the prior 3 months. You see, the secret is to sell high and buy low. Each time an asset class or particular stock has a meteoric climb, it's telling you how much volatility it has. You see, we love upside volatility, though we're not a big fan of downside volatility, though the two are inextricably linked. So when you see something go up by 50%, just know that asset is telling us it could have gone the other way just as easily. Think of your portfolio as a well-coached team. Some players will have breakout games while others provide consistent support in the background. Over time, it's the teamwork that leads to success, not the heroics of any single player. Finally, disciplined investing is about focusing on what you can control. You can't predict the market movements, but you can control your behavior. Stick to your plan, hold strategy, rebalance your portfolio systematically, and continue to save and invest 20% of your income. And resist the urge to make emotional decisions based on short-term marketplace noise. If you pay attention to the short-term noise of assets that are outperforming your portfolio, then as each year passes, you're picking up some mental accounting of how much you've missed out on. It's easy to one day then get upset, sell your portfolio, and transition to a strategy that has looked attractive, but may hit its lull right as you chase your money into it. The longer you stay disciplined, the stronger in your belief in your strategy. Instead of feeling like you're missing out, you'll have confidence that your portfolio is built to weather any market environment as you journey through many of those market environments. If you've ever struggled with the urge to chase market trends, I hope today's episode gave you some perspective. Remember, disciplined investing is about long-term success, not short-term excitement. I'd love to hear your thoughts. Leave a comment below. Let us know. Are you buying and selling short-term stocks? Do you have confidence in your long-term strategy? If so, what is it? We'd love to hear. Thanks for joining me today. Next time we'll tackle how even the best paid asset managers cannot outperform the market. That's it for this episode. Now go back to building a great life.